Every battle is won or lost before it's ever fought. Every trade is a battle, and winning battles requires preparation. And since uncertainty is the only thing that's certain about the markets, you should learn to identify the possible scenarios and prepare contingencies for them. Having plans for every likely scenario increases your chances of closing trades without losses. Welcome back to Book Club. We're going to jump into Chapter 4, Examining How Indicators Work is where we left off. We will pick up there. Indicators can't be easily categorized as belonging to trend trading or to swing trading, although it's obvious that if you're using a long-term moving average like the 50-day, see Chapter 12, it won't be appropriate to a shorter-term swing trade on a daily chart. That doesn't mean that you can't use a 50-period or a 200-period moving average on an intraday chart. In intraday analysis, the period isn't a day, but some number of minutes. For example, the 240-minute bar, or 4 hours, is popular in foreign exchange. That makes the 50-period moving average consist of 8.33 days, fairly long-term when your analysis window is 4 hours and your holding period is 24 to 48 hours. Likewise, a 200 moving average is 33.33 days, which in swing trading is definitely a long-term period. In the sections that follow, I describe the general way indicators work, but be aware that technical traders are sometimes mavericks and use indicators in an infinite variety of ways. Finding relevant time frames. Most indicators measure price and volume changes relative to previous prices and volume over a specific look-back period, such as 12 days or 21 days. Most indicators have a range of time in which research shows they work best. Most charting software incorporates this information as standard default parameters. A default parameter is only a starting point, and if 12 periods doesn't work on your chart, you're welcome to use a different number of periods. 12 periods is the default because researchers found it the best number over many thousands of price series. Be sure to differentiate between the look-back periods, such as the number of days of past data you're putting in the indicator, and your trading frequency. Using a 12-day momentum indicator, say, doesn't mean you'll trade every 12 days. It means simply that for this security, a 12-day look-back period was most effective. Most indicators and patterns can stretch from a few minutes to several days or even many months, with a few exceptions. You wouldn't use momentum, for example, on a monthly chart, but you could use it on a weekly and more frequent intervals. Support and resistance lines can be drawn on a chart of any time frame. You can often see patterns like head and shoulders on 60-minute bars, as well as a chart containing a year of data. Technology offers the ability to put an indicator on the screen that traditionally used, let's say, 12 days, but today it can be 12 periods, and the period could be 15-minute bars. Many traders just leave the default parameters of their indicators in their chart drawing system and use them on every time frame. The ability to apply an indicator over any time frame reflects the fractal quality of prices, the weird and wonderful fact that without a label, a price series of 15-minute bars can be distinguished from a month's worth of daily bars. Intraday bars are like microcosms of daily bars, and daily bars are like microcosms of weekly or monthly bars. Traders respond to price changes in regular, consistent, and repetitive ways no matter the time frame. You should discard the idea that you already know your time frame. You may think you're a long-term trader, but then discover a real affinity for an indicator that works stunningly on your favorite securities, but entails trading 10 to 20 times per year when you started thinking you would trade twice a year at most. You don't want to miss an indicator that seems to belong to a different time frame just because you've already boxed yourself in. The indicator may be more flexible than you first think. You can use short-term indicators to make long-term trades and the other way around. Heeding indicator signals. Indicators are designed to give buy and sell signals, although in many instances the signal is more like a warning and doesn't have a black and white embedded decision rule. Indicators generate signals in 3 ways, as I describe in the sections that follow: crossovers, meeting a range limit, and convergence and divergence. Crossovers. The term crossover refers to one line crossing another line. They include the price crossing a fixed historic benchmark, the indicator crossing the price or the price crossing the indicator, one line of a two-line indicator crossing the other. All right. In most instances, the price crossing an indicator is named a breakout, one of the most important concepts in technical analysis. When a price rises above a long-standing resistance line, for example, technical traders say it broke out of its previous trading range and now the sky's the limit until the new range is established. Usually you want to scrupulously observe and measure a breakout. If the resistance line is at 10 and the price goes to 12, it's a breakout. If the price goes to $10.05, it's also a breakout. The word breakout itself tells you the crowd psychology behind the price move. In an upside breakout, bullish sentiment triumphed. The bulls broke out of the enclosure and are cavorting in the pasture. When bearish sentiment wins, the bears have broken down the fence and are eating your prize roses. A breakout doesn't necessarily imply a trend reversal though. Sometimes a breakout is a confirming factor that the existing trend is gathering new momentum or passing new benchmarks. Range limits. Oscillators describe where today's price stands relative to its recent trading range. As I described in chapter 13, oscillators are usually based on 100, so they range from 0 to 100, or minus 100 to plus 100, or some other variation using the number 100. In practice, traders find that usually the scope of the price range falls well under the outer limits and doesn't vary by more than 20% to 80% of the total possible range. So they draw a line at 20% of the maximum range and another at 80% or 10% and 90% and some other variation. When the indicator approaches one of the lines, the price is nearing an extreme of its recent range. This is a warning of an overbought or oversold condition and thus a potential retracement or reversal. Convergence and divergence. Convergence refers to two indicator lines coming closer to one another, such as when a support line and a resistance line converge to form a triangle, or two moving averages get closer together, indicating less difference between their numerical values. Convergence generally means that the price action is starting to go sideways or has a narrower high-low range, or both. A sideways move in turn generally leads to a breakout, although it can take a painfully long time. Convergence doesn't have an embedded trading rule and is more often used as a warning that a change in direction or the strength of a trend is changing. Divergence refers to two indicator lines moving farther apart, such as when the spread between two moving averages widens. Divergence also refers to an indicator and the price going in different directions, which is the most common and useful application of the observation. Momentum indicators in particular reshuffle the components of the price bar to come up with the price's rate of change, so that the slope of the indicator is a sophisticated measure of the strength of a trend. When the price is still rising, making new highs, but the momentum indicator starts to fall, making progressively lower highs, the price and indicator are diverging. This divergence is almost always a warning that the rising price is going to stop rising sometime very soon. Divergence is one of the few leading indicators in technical analysis and something you should note as a warning of a possible trend change. Although it, like convergence, doesn't have an embedded trading rule, volume is a notable instance of divergence that assists tremendously in making a trading decision. Chapter 3 discusses volume in greater detail. Establishing benchmark levels. Some price chart characteristics are inherent to the chart and independent of your indicators. Every price series has historic highs and lows that are indicators, and yet they may serve to indicate future price action, like the 52-week high or all-time high or low. In some instances, years can pass before the benchmark is matched again. Historic levels are magnetic. They attract some traders to try to break them, but they're also barriers. Hesitation ahead of the breach of a benchmark price can be prolonged, demonstrating that traders are fully aware of historic levels. In addition to historic highs and lows, some analysts like to check out the high or low over the past 3 to 5 days. Most analysts consider the long-term moving averages 20, 50, and 200-day as benchmarks. Historic levels are a cause and effect of strange indicator behavior. If an uptrending indicator like the moving average flattens mysteriously, widen the time frame on your chart to see whether the price is near a historic level. The market is going to test the old high. If the test fails, expect a retracement and maybe a reversal. If the price passes the test and makes a new high, you expect the price to accelerate with high momentum and deliver a juicy profit. Choosing indicators. The good news is that everything works at least some of the time. Moving average indicators work, channel breakouts work, trading in 3 to 5 day time frame candlestick analysis works, but indicators only indicate, they don't dictate the next price move. For one thing, there's that monster noise. For another, fresh news and perceptions of news arrive on the scene. All the newcomers to technical analysis, and many old hands as well, tend to lose sight of the limitations of indicators. Folklore says that technical traders are always seeking the holy grail, or the perfect indicator or combination of indicators that is right 100% of the time. It doesn't exist. One of the reasons it doesn't exist is that you are different from the next guy or a gal. Equally important, you change over time. The ideal indicator that delivered great profits 10 years ago is one that you now avoid as carrying too much risk. In other words, an indicator is only what you make of it. The old joke has it, give 12 technical traders a new indicator, and a year later you have 12 different track records. How you use an indicator isn't set by the indicator itself, but by the trading rules that you use. Indicators and trading rules have a chicken and egg relationship. The process of selecting and using indicators involves not only the characteristics of the indicator, but also a consideration of the trading rules you must employ to make the indicator work properly for you. For example, you may like an indicator but find it generates too many trades in a fixed period, so you don't execute every single trade. This is called cherry picking, and you should avoid letting it become a habit. It will bite you in the rear someday because indicators work on the law of large numbers. Indicators don't work every time, but you don't know ahead of time when those instances will occur. You also don't know when the indicator will surprise with a gigantic profitable breakout. In other words, you have to trust your indicators, and if you don't override them, just get new ones. Or instead of overriding indicators signals with personal judgment, modify the exact timing of trades by using a second indicator. Chapter 16 discusses combining indicators. Modifying indicators with trading rules is always better than overriding them. To override your indicator haphazardly is self-defeating. You're letting emotion back in. Plus, you won't get the expected result from the indicator, and you'll then blame the indicator. Fortunately, most indicators are fairly flexible. They can be adapted to fit the trading style that you prefer, such as the frequency of your trades. Indicators are about price move measurement. Trading rules are about you and your tolerance for risk. Trading rules must be appropriate to the indicators that you choose. In short, don't pick indicators that you can't follow, like a momentum indicator that gives 50 trading signals per month when you don't have the time or inclination to trade that often. Examining indicators in detail. The first step in seeing whether a given indicator can work for you is to test how it would have worked in the past. You expect price patterns to repeat because crowd psychology doesn't change much. Optimization is the process of testing a hypothesis on historical data named backtesting to discover which parameter would have worked the best. In practice, the term backtesting and optimization are used interchangeably. Backtesting is a necessary evil because when you're starting out to trade a new security, you don't know which indicators to use or which parameters to put into the indicators. In keeping with the empirical approach, try various indicators and different parameters in the indicators to see what works. I say that backtesting is evil because common sense tells you that conditions are never exactly the same, and what worked on historical data may not work in the future. Backtests to find good indicators and optimum parameters give you a sense of accuracy and reliability that may be misleading. To perform backtesting and obtain all the data you want about indicator performance, you need your own technical analysis software. Websites and most broker platforms don't offer backtesting capabilities. Constructing a backtest. Backtesting is a valuable exercise that delivers a measure of how well an indicator parameter might work in a situation where you have no other evidence that the indicator will work at all. Backtesting using computer software is better than eyeballing multiple versions of the indicator on a chart because good software can give you all the metrics you need, whereas eyeballing gives you none. I named the 4 top metrics here. A popular place to start backtesting indicators on your security is the simple moving average crossover. The goal of the backtest is to find X, which is the number of days in the moving average that would generate the best profit by using a crossover rule, refer to chapter 12. Here's the formal hypothesis. If you buy XYZ stock every time the price crosses above the X day moving average and sell it every time the price crosses below the X day moving average, it'll consistently and reliably be a profitable trading rule. End of quotations. Just about every software package allows you to search for the optimum moving average and will deliver the results in minutes. In this case, I ordered the software to test every moving average from 10 to 50 days over the past 1,000 days to see which moving average would have delivered the most profit on XYZ stock. The name is withheld to protect the innocent. I also ordered a buy-only strategy, although you can also test for additional gains from going short if you're able to do so. Table 4-1 shows the 3 best results. Fascinating. Results of simple moving average crossover backtest on XYZ stock. Number of days in moving average, average profit loss, these are the columns, percent gain, and number of trades. All right, so number of days in moving average, 10. The average profit loss for 10 days was $1.56, giving a percent gain of 68.6%, and number of trades 178. 31-day moving average, average profit loss $3.02 in the positive, percent gain 59.34%, number of trades 32. 35-day moving average, average profit loss $3.32 in the positive, 61.69%, percent gain with 47 number of trades. If you'd been willing to trade 178 times in 1,000 days, or roughly every 2 weeks, you'd have made 68.6% by using a 10-day moving average crossover of the price. Is that a good number? One way to judge is to compare it to buy and hold. In other words, buying on day 1 and selling on day 1,000. In this case, the software calculated the buy and hold return as 43.4%. So for all of that trading work, you made an additional 25.2%. On a $10,000 starting capital stake, that's $2,520, or did you? No. To get a realistic net gain, you need to subtract brokerage and other costs, of course. It's common sense to look at backtest results after slippage, which is the cost of brokerage fees plus the broker not giving you the exact price on your screen. Checking the indicator's performance after slippage can make all the difference between a profitable trading rule and an unprofitable one. Subtracting a $10 per trade brokerage and slippage cost to the results in table 4-1 changes with it a high dollar per trade brokerage cost. Now the optimum moving average is 31 days from 10. The number of trades is 32. Okay, no, we just went over all of that. This is just highlighting what I literally just read. You're swapping a very high number of trades for less profit. So they're comparing the 32 trades on the 31-day average with 178 trades to, okay, fuck it, I may as well just read it. Okay, that's because the high number of trades and the best outcome carry with it a high dollar per trade brokerage cost. Now the optimum moving average is 31 days from 10. The number of trades is 32 from 178, and the profit is 49.3% from 68.6%. This is only 5.9% more than buy and hold. You're swapping a very high number of trades for less profit. Quick, which one would you choose? The other top metrics in the simple moving average crossover test, I use a single criterion for selecting the optimum moving average, percent gain. But percent gain isn't the only goal. If percent gain were the only goal, you could find yourself accepting a trade regimen that delivers 100 losing trades for every 10 winning trades. The 10 winners each had to be a home run to make up for all of those losses, but you're looking for systematic trading, not a few home runs that may not repeat in the next 1,000 days. Therefore, you also care about the number of winning trades versus losing trades and the average win-loss ratio. You want as few losing trades as possible, and you want to get more profit from the average winning trade than you lose over the average losing trade, right? That's a total of 4 more criteria you need to measure in your back test to choose the best parameter. To choose the best parameters. Ooh. Okay. Backtesting never delivers a single no-brainer parameter. Even after factoring in brokerage and slippage costs, you still have to choose between the parameter that calls for more trades over one that calls for fewer trades, between one that delivers more winning trades than losing trades, and the one that delivers a better win-loss ratio. You hardly ever find a parameter for your indicator that meets all of the criteria. A compromise is in your future. Fixing the indicator. Assume that percent gain is your priority. What comes second? Most people choose reducing the number of losing trades, which is the correct choice. The single best way to reduce your losing trades is to add a confirmation requirement, such as one of the momentum or relative strength indicators. Requiring a second indicator to confirm a buy-sell signal will reduce the number of trades by 30 to 50% without sacrificing much profit. And because the trades being eliminated by momentum confirmation are generally losing trades, the gain-loss ratio improves too. After choosing your indicator parameter, your job isn't finished. Backtest or hypothetical, you didn't actually make those trades. To get more of a realistic idea of how an indicator-based trading rule works, backtest the rule on historical price data and then apply it to out-of-sample data. In the case in Table 4-1, the example I backtested on 1,000 days of data. Now, I should backtest it on the next 500 days of data named a walk-forward test. If the results are about the same on the fresh data, you consider your rule to be robust, meaning it works across a wide range of conditions. Evaluating the risks of backtesting. The flaw in backtesting is that the ideal parameter for an indicator is ideal only for the past, which is referred to as a rear view mirror criticism. Although it's accurate, it's not terribly useful. Critics of backtesting point out that even if your indicator is robust on the next 500 days out of sample data, after you actually add the 500 days to the backtest, the perfect parameter is now some other number. You can go mad backtesting until you're blue in the face and you'll never find the optimum parameter that stays the same over time. The unreliability factor gets worse if you fiddle with the indicator with filters. This is named curve fitting, or making the indicator perfect for the past. The probability of that indicator being perfect for the future is low because the market is dynamic and changes. Bottom line, don't count on finding a magic number to put into your indicators. Now you know why many traders just use the default parameters supplied with software and on websites. I recommend backtesting anyway because it's a tremendously educational experience. You discover not only about the inner workings of indicators, but also about yourself and your own risk performance. For example, you may start out thinking you care more about total percentage gain and are willing to disregard big losses as long as you get a high gain in the end. But when you see that a favorite indicator can cost you 20% of your capital stake several times a year, you may suddenly start preferring a less aggressive indicator that tends to cost you only about 5% in each losing trade. Choosing indicators via backtesting is a journey of self-discovery as well as a scientific exploration. Backtesting has fallen out of favor in recent years, probably because it's a massive amount of work that takes a vast amount of time and ideally should be refreshed repeatedly. At a minimum, you're trying to get the best combination of percent gain, highest gain to loss ratio, more winning than losing trades, and an indicator that is robust across a range of conditions. That's a tall order, and the trade-offs are sometimes peculiar. Adding additional indicators to get confirmation increases the workload exponentially. If you're computationally competent and clever with numbers, you can modify the parameters of multiple indicators to generate a trading system having exceptional profitability. While you're doing that though, you're not doing other things like watching prices move to get a feel for the rhythm of the market. I've known math whizzes who devise a devilishly intricate sets of indicators and revise them obsessively and never execute any trades at all. Okay, that's weird, whatever. All right, fantastic, great. That is the end of chapter 4. It only took us like 2 months to get through it. I don't know what's next. Chapter 5, say guerrilla trading? Guerrilla trading, I have never heard of that. That's fascinating. That's in chapter 5. Hold on to your fucking seat. All right, so chapter 5 goes over managing your trade. Massively important. Even to this day, I sometimes get into trades where I entered very confidently, and then for some reason I just start like fucking panicking when I'm in the actual fucking trade, even though I know all my rules like the back of my hand at this point. But it still happens. Some actual good, useful information in chapter 5. Anyway, thank you guys for joining book club this time. I will see you next time for chapter 5. Peace.